All right. Well, let me start by welcoming everybody. Thanks for being here. It's a chance for us to get together each quarter to talk about what's happening in the economy and the investment markets, our outlook as it relates to these things, and how things have gone in the prior quarter and what we're expecting in the coming quarter. And so let's get underway and get started. Again, our presenter primarily will be Brian Regan, our Chief Investment Officer. And of course, I'm Chris Boyd, the firm's CEO. So thanks for being with us. Wanted to start us off by acknowledging the addition of two new advisors to our firm, the Jeffs, as it turns out. We have two Jeffs that were joining us. Jeff Tomanang joined us maybe about 2 months ago, very recently. He will be helping with our existing client service, so you will hear from him, and he has clients of his own, and I'm sure we'll be continuing to help serve clients and meet new people and help in that process. Jeff Tomanang has an abundance of credentials behind his name, his wealth of financial advisory, wealth manager credentials. So he's a great resource for information. We're also announcing just today that Jeff Perry has joined our firm. Jeff is well known on the Cape and a great addition to our team. So happy to have him joining us. After having completed a career in public service, he's decided to try to help people in their financial endeavors. So welcome to them both, and our clients, you will be have occasion perhaps to talk to one or both of them in the weeks and months ahead. So our agenda today, we intend to review the first quarter, talk a little bit about what's happened with COVID and how things are developing, what that impacts, what we think that will impact for the coming quarter. Government policy certainly has some impact on markets. Yield curve in terms of what's happening with interest rates and how that's impacted your investments, or may still. We'll talk about earnings expectations and equity valuations and our takeaways for what's to come. Let's start with a review of last quarter, and there's lots of good news I think we can go through. That we did have an expectation for earnings growth, and that caused us to allocate a little more fully toward our stock positions, and that was funded in part by some of our bond exposure last quarter. And that's been a good move. As it turns out, stocks have done very well. Bonds have had a little bit of a headwind because of interest rates rising. And our decision to emphasize consumer discretionary positions has been a good position and continues to thrive. We also had made the conscious effort to increase our small cap exposure. In addition to, I would just mention, we do have a position for individual stock investors that is available. For anyone who may want to investigate that, we can speak to you about that. But in our regular portfolios, these are discretionary portfolios, we've added to that position. That's been generally a good move. However, where we took some of those funds from has also done well. So it's essentially a neutral move, but we still think that's been a good decision because we think small cap will continue to be a better place to be positioned going forward. Last quarter, we also took advantage of some real estate exposure, added to that. And that's been a good position for us. We have some preferred stock in real estate. As everyone knows, real estate's been on a tear. Kathy, just make sure that everyone's on mute. There's some background noise. Thanks. And so anyway, that decision has been a good move. It's worked well for us. It did get funded in part by our gold exposure. And of course, that has been a place where we've seen some declines. And we expect to see more of that theme as we move away from gold in the months ahead, the weeks ahead. Additionally, for those who have our core explore strategy, and individual stocks. We've had energy exposure, and that has really paid off this quarter. We had been kind of holding off, waiting for that move to happen, and patience has been a good experience for us. So that's a good overview of some of the things that we made decisions about last quarter. And fortunately, much of that has been good moves in our portfolio structures. Anything to add on that, Brian?
I thought you did an excellent job of summarizing. I think this page here is, I just want to add a couple caveats, especially when it comes to the small cap positioning, which I believe we've been in most of our portfolios for about 9 months, except for maybe the more conservative strategies. In the quarter starting January 1st, it's actually been up 12.7%, which is double large cap stocks. But since we make our changes usually in the third week, in the beginning of a new quarter, it was about neutral with our blend because a lot of the outperformance came in that first month of the quarter in January. So I just want to recap, what we saw in the actual 3-month period from January 1st to March 31st. Large cap stocks, the S&P 500 returned 6.2%. Continues to be on a tear on a 1-year basis following the COVID crisis meltdown. And the only thing that seems to be beating it is small cap stocks with 95%. U.S. bonds, the aggregate bond index, which our bond positions are a little shorter than, so not as heavily exposed to interest rate changes, gave back some ground, but on a 3-year basis, it's still returning 5%, almost 5% annually. So we've seen some great returns there over the longer term. And for high yield bonds, which we've had a position in for about a year now, again, a 24% return. So I think there's a lot of green on this chart, and I think that's just a lot of good news, a lot of things to celebrate over the last year. So, before we get into, all the details of what we want to get into this quarter, I just want to remind people why we do this and what it's all about. Everybody's kind of concerned about their stock exposure, and that's primarily what I like to talk about every quarter. But it's really important to understand that stocks are long-term assets. Short-term concerns mean that you should probably reassess your risk tolerance. So if reevaluate your risk tolerance. So if you are sitting back and you're saying, I have a lot of concerns about what's happening because of X, Y, and Z, you should reach out to us and we should talk because, you're probably taking too much risk for yourself in the long term. And we'd love to readjust that because our goal is to keep you in a strategy that you're going to be able to ride out waves, because ultimately that's how you perform best. Also, what this is about is stock valuations are based on interest rates and earnings. And that's basically it. I mean, the only things we like to address are things that we think are going to either increase or decrease earnings or increase and decrease interest rates. Now, that sounds simple, but a lot goes into that formula. And that's really what this whole presentation is about, right? What do we think is going to increase or decrease earnings? What do we think is going to increase or decrease interest rates? Put it all together into a formula and try to have an understanding of what's going to do well, and it helps us with our positioning. So, COVID is obviously important to all those factors. Chris, you have something to say?
Yeah, I'll just add one thing, Brian. You might want to just share people like the big picture as we get started, before we get into all the particulars. You have a summary at the end, but maybe just give people the headline as far as how do you think things are going to play out? How should we be cautious? Should we be excited about, how we're invested, that kind of mindset?
Yeah. So, I mean, that's a great question, Chris, or a great point. I think a lot of times people ask us, can stocks keep going up? It's been such a great run. We talked about the chart that we saw earlier. It's been a great 1 year. And the short answer is yes. And that's not to bury the lead on this whole presentation, but the short answer is yes. We've seen earnings increase, but we've also seen interest rates increase, which is, generally it's been supportive of the market because earnings expectations have been more significant than the increase in interest rates. And actually year over year, we've seen it, depending on what time frame you take, we've actually seen a little bit of a decrease in interest rates. I think overall the S&P 500 is appropriately priced right now, which means that, we have more earnings expectations upside, then the market's going to move forward. So the general headline here is cautiously optimistic. I do want to
Thanks.
caveat that with one thing, though. We've been in a paradigm for since 2018, and I wrote this in the investor letter that everybody should give a read to. I think it'd be good. We've been in a paradigm since 2018 where interest rates falling have been the primary driver of stocks. Now we're shifting to a paradigm where increases in earnings have to be the primary driver in stocks. So that could mean that we see a little bit more volatility than we've seen over the last few years. So even though I'm optimistic, keep in mind that this is a long-term asset, and short-term bumps, are probably going to be more expected going forward than they have in the past.
So it's not as though they're without risk, but the outlook we think generally is constructive. So that's the good news.
Yeah, so COVID-19 progress is obviously and has been a primary factor in earnings recoveries, right? So we obviously took a hit economically. So I think the most important thing now in the economy is the progress on vaccine and getting back to quote unquote normal, the life that we lived in 2019, if you will. And the good news is I think we're steadily making progress. I mean, in Q4, we got vaccines approved, and now 198 million. I grabbed this off the CDC website this morning. Have been administered. So that means 125 million people, almost 126 million people, or 38% of the US population, has received at least one dose. That's great. So, one dose of any of the vaccines, it does give you a significant amount of protection. So that means that we're moving closer towards herd immunity. Here's a snapshot of the vaccine distribution data. This is about a week old now, but the chart looks the same today as it did then. We've seen a dramatic drop in new cases now that people have been getting the vaccine, a dramatic drop in hospitalization rates, and a dramatic drop in deaths as well. So this is all good news. I do think it's important to point out that there has been a little bit of leveling off due to primarily the UK variant, which spreads much easier. So the quicker that we can all get vaccinated, I think the better towards herd immunity in the summer. Which we've used this slide a few times now, but I think it's still relevant despite the pause in the Johnson & Johnson vaccine, especially now that all folks are eligible to get the vaccine if they can make an appointment. That will hit herd immunity by late June, early July, which yay for summer, right? So I think we have. It's probably going to be the last time I address, hopefully, COVID situation. And by the time we go through this next quarter, hopefully we're talking about things that are more earnings related rather than public health related. But with the change in government, we've had a very active 100 days here, which I think a lot of people are very aware of. But we're going to break down into specifics here. We had a 1.9 trillion with a T stimulus bill passed, which is obviously very significant. So, $410 billion basically went out in personal checks. 246 billion went to extended unemployment benefits. 200+ billion went to public health. 400 billion went to child care and education. I think the things that are important here to note are that about 5% of GDP went directly to individuals. And I have some data later on in the presentation that shows that money is being spent relatively quickly, and that's going to be stimulative for the economy. Whether you agree with the bill or not, I don't really like to opine on politics here, but it will increase spending, which should drive the top line for revenues and hopefully the bottom line for earnings. And that's what we've seen in the earnings expectations as they conclude. Now, there's also been a $2 trillion infrastructure plan. I think you could put infrastructure in quotation marks for a lot of this stuff. And I think it's important to note that it's a plan. It's not yet a bill, so it still needs to go through communities and be worked out. And then it still will be subject to negotiation from probably more moderate Democrats and more moderate Republicans as they work out the final bill that will be voted on. I do look at infrastructure spending, real infrastructure spending, as more of an investment rather than spending. And I do think there's a difference, especially when it comes to addressing the national debt. So I don't think this is completely bad policy. And I do think, like the previous bill that's passed, it will be stimulative. Some highlights here we'll go through. There's been $600 billion in transportation, $174 billion for electric vehicles, $300 billion for a broad-based manufacturing. This data is from the Wall Street Journal, by the way. $50 billion for domestic manufacturing, $50 billion for semiconductors, which I actually think is very important. Might not be the conventional way that we think of semiconductors being part of the infrastructure, but I will talk about in a few slides how I think it's imperative for the 21st century economy that there is some infrastructure spending there, and $50 billion for clean energy. We also have kind of a swash bucket here for job creation and research. And then for housing, buildings, and utilities, we have everything from high-speed broadband, improved power grid infrastructure, and removing of lead pipes, which I think most people would agree is probably infrastructure related. And then affordable housing, which whether you agree with it or not, may or may not be really considered infrastructure. I do want to talk about policy breakdown. This is from prior to the presidential election, what we thought would be the policy breakdown for Joe Biden. And it's really, the reason why I want to point this out is because it's really played out, as the market would have expected. We've had a rather large stimulus. So we passed the 1.9 trillion recently, but we also passed a significant amount. Well, Donald Trump was still president. So you add the two together, give or take $1 trillion. And what we have seen is higher stocks, lower investment grade bonds, higher high yield bonds, and higher inflation. Those things have kind of played out as expected. Now we have a $2 trillion, you could call it clean energy, you could call it infrastructure, however you want. But I expect that when this happens, we'd have a similar impact. We'd have higher stocks, lower investment grade bonds, higher high yield bonds, higher inflation. And I think the market's already reacting to that with the plan. Now, the kicker to that is he also planned to raise corporate tax rates, which would, lower earnings by, I estimated 7% at the time. It would also make investment grade bonds lower, high yield bonds lower, inflation lower. So, you add all this together and it's a net positive for financial markets, risky assets specifically, and likely a negative for your safer investment grade assets. So I do want to talk about what we're seeing in economic data. If you look at this chart all the way to the right, what this chart is showing, this is called the Weekly Economic Index. It's from the New York Federal Reserve. And it tries to take a handful of components and basically puts it into an index to guess how the economy is going to do going forward. And recently, we've just seen it explode. And there's no doubt about it that there's a ton of optimism about the future of the economy. And I do think it's because of vaccines and stimulus. So the yield curve has responded. So when the Federal Reserve kind of controls the shorter end of the yield curve, but towards the longer end, it's really more market related. And what's happened is as inflation expectations for the future have gone up, right now they're between 2.1 and 2.5 for the 5 and 10-year inflation expectations. You've seen the yield curve rise, which has been negative for expensive growth stocks, and positive for value stocks. And we have I have shown some data that we've seen that reversal later in the presentation. And just to help follow this chart, the red line is where the yield curve was 6 months ago. The yellow line is where it was a year ago, and the blue line is the last close as I pulled this chart. We have seen in the recent days yields come down pretty significantly, which has been supportive of stocks. And in just the last couple of days, we've seen a lot of volatility around around the yield curve. But I think there's good reason for that volatility. And for the next few slides, I want to talk about what can cause interest rates to go down, and then I'm going to talk about what could cause interest rates to go up. And then, I want to bring all this together because we just talked about what could be good for earnings, which is stimulus and vaccines, what could be good and what could be good for interest rates, which are these yield curve flatteners. And then the yield curve steepeners, which I'm going to talk about next, could be bad for stocks. And that's, just to reiterate what I started with, that's how we want to think about stock valuation. What's going to move earnings? What's going to move interest rates, and then try to put the puzzle together. So these are things that I think keep the yield curve down. And what you'll see is it's actually negative economic data. So sometimes negative economic data can actually be supportive of stocks if earnings still go up, which is counterintuitive to a lot of people. And I understand that, but it's the way stocks are priced. So unemployment continues to be high. The basic story here is people will spend more money when they know when their next paycheck's coming. There's about 8 million people that still don't have a job that had a job prior to the COVID crisis. So that's a lot of jobs that need to come back. So even if we were at 1 million per month, which I believe was the last data point that we had, it would take 8 months for us to get back to full employment. And I do expect that it will take longer than that. And that's largely what this next slide's talking about. This is the labor force participation rate for prime age workers. So prime age workers are basically 18 to 55, give or take. What it's trying to measure, some measurements are a little bit younger, 16 years old. Some are a little bit older, to 65 years old. And depending on who you look at, it can change. But this is trying to say, of the people who should be working based on demographics, how many are working? And you can see that from the financial crisis, we trended down. And part of this is demographics, people retiring a little bit early. But part of it, has been that we've had stalled wage growth. Now, we started to make a little bit headway in this between 2016 and 2020 before the COVID crisis, which just dramatically shot us down from 63% to 61.5%. So there's a lot of work to be done to get people back to work, and which would encourage a little bit more spending in the longer term. So I think these are things when you think about long-term interest rates that are going to keep us a little bit, keep a lid on things. This is really saying the same story. People who have been unemployed for 27 weeks or longer are considered long-term unemployed. It takes them longer to get back into the workforce than people who are more recently unemployed, and it will take them longer to feel comfortable spending as the economy recovers. So this is the wage growth chart that I was talking about. You can see that we started to get a little bit of recovery between 2014 up until the COVID crisis here. And I think, if we can get some energy back into wage growth, then we can, push this thing forward a little bit quicker as we can eliminate the scarring and bring people back into the labor force. But right now, it's still relatively subdued. If you look back into the 98, 2000s, 2002, we had 5% growth. And even before the COVID crisis, we were, looking at 3.5%, 4% growth. So we have a long way to go here, and I think this is the primary reason about why you're seeing the labor force participation rate stay low, and a good reason on why we've had long-term stagnant interest rates. We have a lot of excess capacity, especially in the service sector. So, a lot of people are worried about inflation as things start to reopen. That is a reasonable concern when it comes to goods in the economy. When it comes to services, there's a lot of empty diners. There's a lot of empty airports and hotels. As people rush to go out and go have fun, these people are going to be welcomed with open arms. They have empty hotel rooms and open seats on the airplanes. So I think what you'll see is that these places won't necessarily have to raise prices as much because they're not going to be at capacity, at least not initially. So I think this is a chart that shows semiconductor and other electric component parts over the long term. I think many people have heard of Moore's law, where basically electronics and semiconductors have gotten cheaper and cheaper over time at an exponential degree. And that's really what this chart's showing. Since 2016, we've seen a continued decline in these things. Now, what we've seen and what we've heard from specifically semiconductor manufacturing companies, like Applied Materials, for example, is that there is a shortage of semiconductors, and we're hearing this from car companies as well that are holding back production of cars because they don't have the electronic component parts. And this is because there was an expectation that they weren't going to have demand, and now with the rapid economic recovery, they have an overwhelming amount of demand. So the supply is going to take some time to catch up. Now, we haven't seen prices rise yet, and I have this chart updated through March, and the decline is continual. But I do expect, based on the reports, it hasn't flowed through the data yet, that we will see an increase in semiconductors. Now, why is this important? It can take years to ramp up enough semiconductor capacity to meet the demand, is the expectation. And even 1 or 2 years can cause a significant price increase in a lot of the things that we've become accustomed to. So, we're doing a Zoom meeting right now. Everybody's computer has DRAM and logic and flash chips in it, and those are the component parts that we're talking about here. It's also going to be in your cars and et cetera, et cetera. It's the new economy. It's the Internet of Things, and the reason why I think this is important is because a lot of people are talking about inflation like 1979, and I've done a lot of studying over the last 3 months about the inflation of 1979. And what caused it. And the primary reason I think most of us know is the oil embargo and how important oil was to the domestic economy back then. I think semiconductors is the closest thing to the oil situation that we faced in 1979. So this is an important thing to keep an eye on. Right now, not a problem. Right now, still keeping interest rates low, but definitely something to keep an eye on. Definitely something that could be a drag on earnings. And definitely something that I'm concerned about going forward. Now, yield curve steepeners, these are things that we're already seeing inflation impacts come into. And a lot of this, what you'll see is we expect it to be temporary. They're goods, not necessarily services. So we talked about in the prior how we expected services to be able to meet the demand. Now we're going to talk about goods and how they can't necessarily ramp up as quickly. But in time, 9 months to a year, I do expect that supply will be able to catch up to demand. A good way to think about this is during the COVID crisis, we didn't have enough toilet paper, right? Because demand shot through the roof. But in time, we all have enough toilet paper and masks within 3, 4, 5 months. And that when the Fed talks about transitory inflation, that's what they're talking about. It is going to be a problem for a little while, and then as more supply comes on, it'll become less and less a problem going forward, and not necessarily a long-term systematic issue. So here's building permits and durable goods showing rapid increases. Both these things are forward-looking. So you're not going to buy a durable good for your company unless you think that you're going to have, which is typically like machinery or computer equipment, a long-term asset. Unless you think you're going to have a longer use for it going forward. You're not going to pull a permit to build a house unless you think you can sell the house 9 to 12 months from now. So it's a forward-looking indicator 9 to 12 months from now. And these things are off the charts good. Steel and plastics, we're seeing rapid increases in demand. And if you look at a steel company, if you look at U.S. Steel, for example, you'll see that their stock went nowhere for a very long time, and all of a sudden it's red hot. And this is the reason why you're seeing that the demand for steel is skyrocketed through starting with the summer of last year. And even further than we were in the height of the crisis. I mean, in the height of good times in 2018, 2019. There is, without a doubt, especially in the plastics industry, to me, excess supply, excess capacity that can catch up with supply with some time. For example, I know of some oil manufacturers that do the chemicals for plastic resin that are operating at about 70% supply. And as the price goes up, they'll welcome opening up new supply. So I do think this is going to be a transient issue, but nevertheless, it could be a drag for the next few quarters. Retail sales growth has been off the charts. The most recent number had almost 10% increase in retail sales growth. So basically, Americans get stimulus, they spend stimulus. And I do have some information that goes a little bit deeper into that coming up. And I'll get into the details of what we've seen and what patterns that we've seen and how Americans are spending. This is a chart of global supply, and you can see that it's volatile, but we did hit a significant low during the COVID crisis. And you can see that the only time that we had a similar low was during the financial crisis. And now we're seeing a significant turn up. And why is this important? If goods become more expensive to ship, well, it's one of those things that will that can add to earnings pressure. So this is what I want to break down the patterns that we're seeing in personal savings and stimulus as Americans spend. So when the pandemic started, Americans stopped spending about $2 trillion from February to April. And that's the red line that you're seeing there as it dropped. So we were spending around $15.5 trillion, and it fell pretty significant to around $13 trillion. And at the same time, the government gave Americans about $2 trillion from the CARES Act and the unemployment benefits and that's the light blue line towards the bottom. So we didn't spend $2 trillion, and the government gave us $2 trillion, and the net benefit was that we had about $6 trillion in excess savings on an annual savings rate. And what happened was Americans went out and they spent that excess savings. There's just no doubt about it. You can see the blue line fell all the way through to December of 2020. And then we got another stimulus check. Savings went up and then dramatically fell as Americans continue to spend. So this is one of the reasons why we've been very interested in consumer discretionary stocks, for example, and why we've tilted the portfolio that way. Because Americans are spending and without abandon. I mean, if you look at like same store sales at Target or Costco, it's off the charts. I've never seen anything like it. So I think that's generally good news for stock positioning. So now I want to talk about investment evaluation. I'm getting towards the end here, and if anybody has any questions, we're going to be happy to take them. So please, prepare your question and get ready here. We'll be happy to address them at the end.
To do that, you can use the Q&A section. That's probably the best place to post your question. That's on your panel of options. You can also use the chat bar and or raise your hand if you want to ask a verbal question. We'll save those primarily till the conclusion of these remarks.
So this chart we show every single quarter. It's from JP Morgan. It's an excellent chart to give you kind of a snapshot of relative valuations over time. It's just the problem with the chart is it's only one data point, and it does require an extra level of analysis. So what we're seeing is that the long-term average of price to earnings multiples are high. It's been stagnant a little bit for the last couple of quarters, but it gets a 25-year average. It's no doubt it's high, right? It's 22.5 versus 16.6. We think that's likely okay because interest rates are well below their 25-year average, and that really helps explain that difference for the most part. Now, the other aspect of that is earnings expectations going forward are very large. So this chart takes into earnings expectations in the next 12 months. The 12 months following that in the 2022 are also expected to be very big. So there's a lot of optimism going forward. So that should, in time, even without a decrease in the stock market, be could bring down this line more towards a reasonable longer-term average. So that's one of the reasons why, even though it looks expensive, when you get into the details, it's a little bit more reasonable. So I hinted at this earlier. In this chart, we've been showing something similar to this for the last couple quarters. The blue line represents value stocks, and the gold line represents growth stocks. And what we've seen is that growth stock, and this is a year-to-date chart, growth stocks are giving way to value-oriented stocks as the recovery takes a foothold and interest rates rise. So you might remember last year that growth stocks really ran up high and did really well. And that's partly because interest rates were coming down. Now, the flip side of that is when interest rates start to go up, value typically outperforms growth. Now, at the same time, when we're going through an economic recovery, cyclical stocks, which tends to fall into the value bucket, value-oriented bucket, will also outperform as they hit trough earnings and start to increase. So that's what we've seen more recently. You can see a really significant divergence in there starting in the first week of February. So this is one of the reasons why we like small cap stocks as well, because small cap stocks have a bigger emphasis on financials, materials, industrials, smaller healthcare stocks, and they tend to be more cyclical. And that's why they've shown, if you look at that chart that we showed at the very beginning on how small cap stocks have done, they've far outperformed over the last year, almost had a double, and that's because of the cyclical nature. So this is more example of what I was talking about with expecting earnings growth. This chart's from Morgan Stanley, just so the people know this isn't just my opinion. This is the greater opinion of the market that earnings are going to rise in the future. They're very optimistic about 2021 with almost 25 to 30% growth rate in earnings. And then again, in 2022, they're expecting another 10% growth rate in domestic earnings. Now, it's even better when you look at Europe and emerging markets. So, something to consider there. And again, this is from Fidelity. This is showing quarter by quarter expected growth. They're expecting a banner second quarter of 2021. So right now we're getting earnings from the first quarter of 2021, and first quarter of 2021 looks very good so far. And obviously they look like it's only going to get better in the future. So this is what's driving a lot of the optimism in the stock market. This is some more information on the small cap stocks that I was talking about. You can see how this is profit margins or operating margins, and you can see how it just rose off a bottom in that blue line there, right? So this is the cyclical nature that I was talking about. They're more negatively impacted when things are going really poorly, and they're the first to recover when things are going great. So this is why we've been in it. This is why we're going to continue to be in it. And this is also why we wanted to do that small cap individual stock portfolio that Chris mentioned at the top of this, because we thought there was a little bit more opportunity for folks that are willing to take a little bit more risk.
Brian, this chart may not speak to people as much as it does to you, but the essence of it simply is saying that there's a pretty significant jump in earnings potential that we're seeing forecasted. And it is a common occurrence as we emerge from a recession that smaller companies tend to lead the way, and there's greater opportunity. And so that, again, is some of the backdrop as to the thinking behind this, as to why it may make sense for us across our portfolios to increase our small cap exposure as part of it. We do take into account that there's more volatility, and we address that in the way we think about how we structure the portfolio, how to have that risk accounted for. For people who are more comfortable with a piece of their portfolio being more speculative, we have this specific portfolio design that people may want to take an interest in. So, okay, thanks.
I didn't mean to cut you off by changing the slide. I just wanted to show that this particular chart might be a little bit more clear It's showing the same thing, but it's just showing operating earnings per share rather than margins. So it's telling the same story. Because margins are going up, earnings expectations are going up. And so that's all great for the smaller cap portion of equity. So we've been in a gold position for almost 2 years now, and it increased throughout 2020. And what this slide's mostly about is we're going to reverse that trade this quarter completely. We did some last quarter in front of the real estate. Now, for the most part, we're going to be exiting it completely. And the bottom right part of this chart, the developed market interest rate differentials, is why we're getting into it. You can see that there was a dramatic drop in that line, which means that gold should outperform. And now that we're seeing a rise in that line, we want to reverse the trade. And what that just means is that U.S. interest rates are higher than other developed market interest rates, like the German Bund or the Japanese yen. And what that means is that international money is likely going to flow to the United States, and the dollar will rise. And since the gold is priced in dollars, that would mean that gold would likely fall. And that's what we've seen. And if you look at the U.S. dollar in the left chart, we have seen an uptick in the dollar. Obviously it's a little bit volatile, but if you compare the correlation between the left chart and the bottom right chart, you'll see a pattern. And if the chart on the top right is about the trade balances. I don't necessarily want to get into that because it'll kind of muck up the conversation. But basically, the higher the interest rates from differential from developed markets around the world means that there's probably going to be more flow to dollars, which should be negative for gold. That is kind of a complicated concept, and I'm happy to answer any questions about it because it is a bit of a change from what we've been talking about for almost 2 years now. So I'd understand if there's a little bit confusion, and there's naturally going to be a little bit confusion when I'm selling something that's done so well. And I think that's understandable. So the takeaways are: we expect to reach herd immunity by the second half of 2021. Great news, and I think the economy is going to reflect that. On top of that, we're getting large fiscal stimulus from the government, and fiscal stimulus tends to be expansionary. It also tends to be inflationary. So those are things that we need to keep an eye on. Inflationary environments tend to be bad for high growth, high price stocks, and can benefit more value oriented or stocks that have cash flows closer in the future. I expect this to benefit small cap and consumer discretionary positions because consumers have more money to spend on discretionary items, and we've seen that time and time again as we've gotten stimulus checks. And small cap has been benefiting for the last year from the recovery, and we expect that to continue. So the United States is still in a deep recession, which could keep inflation in check in the near term. So despite the fact that we're spending money and that could be inflationary, we are in a deep recession, which means that it'll slow people down from spending a lot of money, which could keep excess inflation in check. We have seen commodity prices rise in the economy, but the market expects inflation to be transient. The Federal Reserve expects inflation to be transient. I share the sentiment, especially when it comes to the service economy, because there is the excess capacity to meet the increase in demand. We will have a longer, more dramatic increase in goods inflation. If you catch that in a headline in the news, know that we expect that in the longer term to be transient as well. But there's nobody doubts that we're going to have inflation in goods. I mean, just if you compare one quarter over another quarter, it's naturally going to happen because we were shut down in 2020. Now we're open in 2021. That's called base effects. And when somebody wants to write a headline and get clicks, they're not going to talk about base effects. They're just going to say the boogeyman inflation's coming. So we need to look at this a little bit more analytically. It's not black and white. It's a little bit. It can be difficult to understand and tease out, and we definitely need to monitor it because it could be something that we might change our minds on. With a few decent data points. But earnings expectations continue to rise for 2021 and 2022 as the recovery continues. And like I said, what we really care about here is earnings and interest rates. And earnings are expected to be great. So that's all good news going forward. Risks include COVID, of course, input shortages, like we talked about, if companies start to have higher costs because of these inflationary pressures in goods that we're talking about, and they start that hits their bottom line, that could be negative because it could hurt earnings. Geopolitical concerns, specifically over Taiwan and ongoing tariffs, are inflationary and they continue to be a concern. Earnings and like I kind of talked about earlier, earnings need to drive stocks higher rather than interest rates going forward. And this is a paradigm shift that will cause more volatility on a day-to-day basis, a week-to-week basis, or overall, as long as earnings continue to move higher, we should be constructive on stocks. And then finally, bubble activity. I've been talking about this for a while, but I do think, bubbles in certain new asset classes can have systematic effects, especially for increases in volatility as those bubbles deflate over time. And I do think that we've seen some air come out of those bubbles as of late. Specifically, the SPAC market has, and the IPO markets have given back a little bit from their hot starts. With that, I think we're happy to take questions.
We do have.
Thanks, Brian. Yeah, go ahead, Kathy.
We do have a few questions that have come in, so let me address those.
And just before you do, Kathy, maybe we can remind everyone, if you'd like to ask a question, there's a couple of ways you can do that. If you want to do it verbally, you could raise your hand and we can recognize you and give you a chance to speak, unmute your line. If you want to do it in writing, there's a Q&A section or the chat room, and either one of those we'll be happy to receive. Go ahead, Kathy.
Great, thanks, Chris. This question is, can you talk about how your opinions and analysis are affecting how you invest in our portfolios?
So Brian, you kind of just summarized that in part, but maybe you can put some specific trades into that context, maybe even just going back to the last slide in the process. Just hit the headlines as to which trades we're envisioning. You talked about gold, you've talked about other things.
Yeah, so I think to highlight what we plan on changing, a lot of this isn't a change. I think the changes that you're going to see this quarter are going to be minor. We're going to increase consumer discretionary a little bit. We've already been in it for a while. We're going to increase a small cap a little bit. And not even across all strategies, depending on where your risk preference is going to be the amount of change that you're going to see. We are going to decrease gold, and we're generally going to be increasing the real estate and investment grade positions. We're going to decrease the high yield position a little bit. So they're going to be modest. You might not notice them if you look at your portfolio today and you look at your portfolio a week from now. To you, it might look very similar, but to me, it's I think it positions us a little bit better for the current quarter. I think the crux of the question is about bias, though, about how my opinions reflect the portfolio changes. And, I think bias is something that I am very, very cognizant of. And, I think as investors, you need to try to set your biases aside and really concentrate on what the data is telling you. And, that's why I go through these slides, which might seem wonky and might seem too detailed. But it's because I want to show you that these are data-driven decisions, not necessarily, based on whatever opinions I might carry.
Thanks.
Great, thank you, Brian. We do have a couple other questions. These seem to be kind of related, so I'm going to pose them both together. One is, will there be a downside or reckoning to all of the government spending? And the second question is, do you see the increase in corporate taxes affecting the recovery of the job market?
Well, I'm going to take the taxes one first. I think the national debt one is it's a more complicated answer, and I think the highlight is nobody knows really to what extent and when there will be reckoning, but there is a lot of evidence of one currently. But for corporate taxes, so I would my guess is that the market is pricing in a new corporate tax starting in 2022 of 25%. And that's based on what I'm seeing from the earnings expectations and what I'm reading from other investment strategists. Now, if the corporate earnings is 28% rather than 25% as as proposed, then yeah, I expect it to be a drag on earnings. I would expect there to be a bit of a correction. I wouldn't expect it to be overwhelming though, because some of it is already priced in, and some of it's already priced in. I just leave it at that. When it comes to jobs, if a company is going to be paying more in taxes and they want to defend their margins, then they could, in theory, cut jobs. So if you're going to be objective about it, then yeah, it could absolutely affect the job market. But these corporate taxes don't happen in a vacuum. I also expect demand to be very high, and people are going to need to hire workers in order to meet demand. So it's there's no easy question to that, but yeah. If you add another cost to a company, it's likely that they might try to defend their margin. Just on a national debt, real quick. So I have a longer answer to this, but what I think is important to note is that the national debt is a problem when inflation has a very significant and persistent change. And I think that's important. So we haven't seen that. And even in the last chart I showed that the dollar actually is getting stronger when interest rates got a little higher. And people were happy to fund us with all the additional trillions that we've been borrowing. So we hit about 1.7 on the 10-year, and we fell rather quickly to 1.5. And that's just because there's a lot of natural buyers as the reserve currency of the world. So dollar strength relative to interest rates, it's an important metric to watch, that we monitor. And I think that's kind of my short answer to this. I have a longer answer to it, but right now we're not really seeing a lot of evidence of the national debt being a problem.
So I'd like to offer a couple of comments as well, and I think that all three of these questions kind of tie in one particular instance. I think when it comes to some of what's happening in the world around us, we have the inclination to often interpret the world through the political lens. And, the first question about bias a little bit, we try very hard to step out of that ideological or political lens that each of us has. And among our team, there are different inclinations as it relates to our political, perspectives, I'm sure. But what we're really interested in is how does this affect portfolios, and how, as managers of investments, it's not about our political preferences and how we might vote. It's about how does this translate to markets. And so, I think right now one can convincingly say that between fiscal policy being very stimulative, whether it's citizens or governments, there's spending happening, and that is stimulative for corporate profitability. When it's monetary policy, the Federal Reserve has clearly indicated a very easy policy that's going to be stimulative in nature foreseeably. And then add to that the circumstances of our vaccine dissemination, and the concerns of COVID become increasingly less worrisome, and the ability for people to go out and spend, work, whatever it may be, it will have economic benefits that are likely to drive stocks higher in the near term. Now, the question about debt in the day of reckoning, naturally, this is a concern to people. And I think it relates very much to the question about taxation. Because of that sensibility, people worry about this, and we have been spending a lot of money, and we continue to expect to see more government spending. That's going to drive taxes higher. That's just a probability, a likelihood, and therefore, corporate taxes are likely to have, some measurable impact on earnings, and we can quantify that once we know what we're dealing with and evaluate how that should impact portfolio design. When it comes to personal rates and capital gains tax rates, it's maybe a little more difficult to quantify, and it may become more individualized as to how to think about that for what makes sense for your circumstances and how that makes, where we might want to be driving choices. And that, let's face it, if everyone decides to be a seller to rush to realize some capital gains or something because of changing tax laws, that could have some temporary market impact, but it's not necessarily the driving consideration. So these are all definitely factors that we pay attention to and can have an impact on how we think about portfolio design. But today we have a lot of unanswered questions as it relates to tax policy. There's possibilities, but there's not absolutes. And so I think it becomes a question of considering this in the financial planning realm, and maybe to a lesser degree in the portfolio design. Brian, do you want to comment at all about any of those points?
I think you did a great job summing it up, Chris. I just add to remember that stocks are long-term assets. If you have a short-term concern, which can include taxes, talk to us. We can help you with it. That's what we're here for. But we manage the portfolio with a longer-term outlook.
I think it's worth maybe just reiterating a couple of key points that you talked about during your comments. One is the idea that we do expect inflation, but we, at this point, expect it to be short-lived. So, don't get overworked up about the prospects of inflation. It's something we're considering as to how we think about design and implications. But by and large, it's not a grave concern in the way we're looking at your portfolio. It's something that we think will be temporary, but noteworthy. And we will pay attention to it in case it becomes something we need to impact our portfolio structure and design.
Yeah, I great point, Chris. And I just add one caveat. Small cap stocks are actually the best hedge to inflation. So it's just another reason to tilt towards small cap stocks.
And I think one other thing that is a question that's come up recently, and I think worth just elaborating again briefly. If interest rates have been rising and, because of potentially, improving economic conditions, that worry of potential interest rate risk concerns, it's worth talking about briefly how worrisome should that really be and why it is that we don't want to run away from bonds.
Yeah, that's a great question. I think one we get a lot. You could be really risky with bonds, or you can be relatively conservative, or you can be somewhere in the middle. We're on the relatively conservative side. We target a duration of about 4 years, which means that if the 4-year interest rate, not the 10-year, not the 3-month, but the 4-year goes up 1%, then you'll lose about 1%. The 4-year going up 1% would be a really significant move in the 4-year bond. It's not something that would be expected. It would be quite a shock. And even if it did, it would be a 4% move. It would actually be less than a 4% move. And the good news about that is you get to reinvest in at the new higher rate. So relative to stocks, a 4% move, which would be the absolute worst case scenario, I would think, or not, I don't want to
maybe not absolute, but out of the norm.
It would be well out of the norm move, is significantly less than a well out of the norm move for stocks. As we all know, we've seen 10, 11% down days in stocks before. A 1% move is not going to happen over one day, that's for sure. And you get to reinvest those coupons at the higher rates. So when you expand your time horizon just a little bit, rising interest rates can even be a good thing, because as you reinvest at the higher rates, you start getting paid the higher rate. So as long as you're not really long, if you have 20 to 30-year bonds in your portfolio, those can be pretty dangerous. We're on average around 4, which there's a reason for that. We want to benefit if interest rates go down some, and we don't want to be holding the bag if interest rates go up. It's a kind of sweet spot.
You've talked about that notion that we do want bonds to be a ballast to stocks as well, and that's important that we don't just have short-term bonds in the portfolio for that purpose. And I think you've said it really succinctly in the past. You kind of referenced this just now, but a bad year in bonds is like a bad day in stocks. And so, I think that's a great thing to keep reminding our clients about, that it's okay to have a little volatility. We're going to make that back mostly with income, and then potentially higher amounts of income over time.
Yeah, I can't take credit for that one, but I really like it.
Yeah, I like that too. All right. Are there any other questions, Kathy?
We don't have any at this time.
All right. So then we'll just give one additional invite. If anybody has other questions, feel free to raise your hand, squeak it in. Otherwise, I think we'll start to wind things down. Brian, you mentioned that there's not going to be a lot of trading to deal with this quarter. That being said, we do go through a rebalancing endeavor each quarter. People can expect that over the coming weeks, that we'll probably be doing that shortly to try to implement some of these changes. If people have questions about their portfolio, any aspects about their financial planning, or just issues in general that they think we can be of help with, feel free to reach out to us. There's a variety of ways you can do that. You can email us, client service at amrfinancial.com is an easy way to get connected. You can also reach out to any of us by name through our email address at amrfinancial.com to schedule a meeting or ask a question. With that, I think we can kind of wrap things up. Any final comments? Anybody else? No other questions? All right. Thank you so much for your time, for your business. We just appreciate the trust you place in us. We take it very seriously and put a lot of attention into trying to serve you well with the way we've invested your funds. So if you have any questions, don't hesitate to reach out. With that, thanks everybody for attending today. Brian, great job. Thanks for your efforts.
Thanks, everyone.